Archie, I don't really like bonds. Do I have to have them in my retirement portfolio?
Rob, that's a great question. Let's clip that coupon. I'm Archie Hoxton,
And I'm Rob Hoxton.
and this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck podcast. We're certified financial planners Archie Hoxton and Rob Hoxton. And today we've got an interesting topic for you. I think it's interesting. Most people would say it's kind of a boring topic, actually.
Well, it's a question we get a lot, so it's obviously on people's minds.
Right, and it's really important, and it's something that is commonly misunderstood, but it really ties in with an episode we did a few episodes back. We talked about stocks and whether you need them in your retirement portfolio. So today we're going to talk about bonds.
We're going to flip the table a little bit here.
Right. Because, you always hear, you have stocks and bonds, and they kind of go hand in hand in a retirement portfolio, but not everybody agrees with that. Not everybody likes them. So I'd say to start off, Rob, what would you say if someone asked you, hey, what is a bond? How would you respond?
So, I might start by saying, what is a stock? So, a stock is an equity share of a company. And if you own that share, then you get a fraction of the profits that the company generates. And of course, if the company is more profitable next year or the year after that, then the price of the stock should go up fundamentally. A bond, on the other hand, is a debt instrument. So when you buy a bond at the original issue, you're actually lending money to the issuer, whether it be a state government, a municipality, the federal government, or a corporation. So let's say a corporation needs to build a massive facility to store and transfer packages like Amazon might. A traditional way to get money to do that would be to go to the bank and borrow it, but they need to borrow so much money that generally what they do is they go to the capital markets. An underwriter like a Goldman Sachs or a JP Morgan or somebody like that will help them issue bonds and sell those to investors. And so when you own a bond, you're not actually getting dividends, you're getting interest payments, which is a little bit different than stocks.
Yep.
And frankly, they perform a little bit differently.
They do. So you're acting as the bank rather than as the shareholder, like you would with stocks. So it's it's important to understand those differences, and you're going to see with differences in what the instrument actually is, you're going to see difference in, like you said, Robin, how it performs and what influences the price, right? So because when you own a bond, it has a face value, right? Say $1,000, and then it has a coupon rate, and that coupon rate, let's say 6%. That's your interest rate. So the company's borrowing $1,000 from you, and they're paying you back 6% over a stated period of time, a year, 5 years, 10 years, 20 years, even 30 years. And so because of the nature of bonds and the capital markets, you might be the first person to own that bond. You lend the money. Maybe a few years down the road, you decide, you know what? I don't want to own this bond anymore. You can actually sell that on the secondary market. You're selling it to another investor or an institution or something like that, and you're getting a price back for it. Maybe you get your principal back,
Plus any earned interest that you haven't received yet.
Any earned interest, right?
Called accrued interest, yeah.
Right. Ordinarily, if you own the bond to the maturity, you get the interest and then you just get your principal back, like when you're paying off a loan. In that case, though, you may not get your full principal back. You may get more than your principal back, right? It all depends on the market forces that are informing other investors as they consider buying your bond.
So yeah, if we touch on that, so there's a relationship between current interest rates and bond prices. So if interest rates rise, then bond prices generally, currently issued bonds generally decline.
Right.
And the reverse is true. If interest rates decline, then bond prices go up. And we saw that for, 10 or 15 years as interest rates continue to head lower. Now that trend has reversed itself, And one of the reasons why the bond market last year had maybe its worst bear market in 100 years was because of rising interest rates, you know, at the hands of the Fed and of course the market itself.
Right.
So, you know, there are risks associated with bonds, and that
Right.
would be the moving of interest rates. Another big risk would be credit risk, right? So
Right.
anytime you're lending money to a person or an entity, if they don't pay you back, well, then you're in trouble. So there's credit risk, and some borrowers have stronger, um, credit records than others,
Right.
credit scores, and that's something to watch out for as well.
Right. Now, you can find this information, right, where we have, FICO scores. The bank can pull that if they're thinking of lending money to us. They can pull your FICO score and determine what the right interest rate ought to be, how much they should charge you to borrow their money, right? You can do the same, right? There are ratings agencies, Standard and Poor's, Moody's,
Fitch.
that they actually rate governments, corporations, municipalities on their creditworthiness. And
Their ability to pay that loan back.
right.
Yeah, so that's a risk. But when we think of owning bonds in retirement, now I personally, having been an investor for so long, I prefer stocks. Stocks have a higher long-term expected total return than bonds do. And for me, I'm comfortable with volatility. Why wouldn't I just own stocks? So, and that's a really important question to answer, and it's one that we get a lot. Frankly, if people are thinking about what their portfolio structure should be in retirement, they're like, well, why wouldn't I just go with the thing that has the highest expected return? And that's because when you're working and still saving for retirement, volatility is your friend. So anytime you have a big bear market or, that kind of volatility, if you're dollar cost averaging into your investment, you get more shares when that temporary decline in the market happens. If you flip it and now you're taking money out of your investment, that volatility really works against you.
Right.
So having a portfolio just of stocks may not be the best choice. It's certainly not the best choice in the drawdown years for most people.
Right.
Having investments that aren't perfectly correlated with stocks, as is the case with bonds, makes a lot of sense, even though the expected return is lower.
Yeah. I explain this to people all the time when they ask me, why would I own bonds? If you're retired, higher return doesn't necessarily, and when I say retired, I mean you're drawing on your portfolio, you're taking distributions, you're selling shares of your investments to meet your income needs for your lifestyle. In that case, higher return doesn't necessarily translate to, portfolio longevity, right? It may actually shorten the life of your portfolio because of what you said, sort of that reverse dollar cost averaging. It's great when the market's doing well, you're selling shares, you're taking distributions, you're selling fewer shares to get the same number of dollars. But when the bear market hits, which they always have, they likely always will, you're selling more shares to get the same number of dollars. And so you're more quickly draining your portfolio.
Right.
When you have bonds in the picture, you've got the income that's generated from the bonds. You've got the actual bond principal. You can sell the bonds themselves. Maybe you own exchange traded funds or mutual funds that hold bonds. You can sell those. So certain times in the market when the stock market is down, sometimes the bond market is where it was or even higher. That's the time to be selling. So that's what we mean when we say assets that aren't perfectly correlated with one another.
Yeah, they're not moving up and down together. Now, it's true that last year stocks and bonds went down. Bonds went down less, even though it was the worst bond market, bear market for 100 plus years. And it was also true during the Great Recession. Stocks and bonds kind of held hands and jumped off the cliff together. So it's not a perfect scenario, but there's an argument, a really strong argument that can be made for having a diversified portfolio in retirement that includes bonds.
Right. Absolutely. Yeah, I think that is, if the goal is a successful retirement where you can meet your needs using your portfolio for the longest period of time, because we don't know how long we're going to be on this earth, right? And generally, a good financial planner will plan relatively conservatively, accounting for the potential of a longer lifespan than you would expect.
Yeah, I mean, at Hoxton Planning and Management, we assume that you'll live, a married couple will both live to age 95, which is substantially longer than our actual life expectancies are. But I got to tell you, I have never wanted to be in a position to call a client and say, hey, congratulations for living a long time. Next month's check is the last one. I just don't ever want to have to make that phone call, right? So we plan conservatively.
Yeah.
And if you're working with a financial advisor, you're doing it yourself. We always recommend working with not just a financial advisor, but with a certified financial planner. Make sure that they are using a long life expectancy in your financial plan assumptions.
Right. When we say Last Paycheck podcast, we're not talking about that last paycheck.
Right. Yeah.
We don't want that last paycheck to ever happen. Yeah. And that's why it's important to plan conservatively. And oftentimes, when you've been in the accumulator mindset where it's, I want the highest return I can possibly get. When you're in that mindset and you're chasing that return, you have to really shift your view to, okay, I want to continue to maintain the lifestyle that I desire throughout the rest of my life while I'm not working for a paycheck. And you've got to make that the ultimate goal, because if you chase those returns, you might inadvertently sacrifice that portfolio.
That's
longevity.
A great point. In fact, this is something we get frequently. I had a client, longtime client, 30 years almost, who was a very successful professional and has been retired for, I want to say, 15 years. And we have these, and you could hear him from your office. I was in the conference room with him, Archie, and you could hear him, and you said, golly, that was an interesting conversation. It was that loud, but he likes to come in and say, look, the S&P 500 has done 15% so far this year, and my portfolio is only up 11%. And I have to say, well, let me remind you, because we have this conversation just about every time we meet, your portfolio is not comprised of just the S&P 500. And that's because you're drawing down on your portfolio. You have to have a mix of assets. And I said, what's really most important to you? Is it most important to you that your portfolio match or beat the S&P 500? Because we can probably at least match it. But is it more important to do that, or is it more important to achieve your financial goals and not run out of money during your lifetime? And he looked at me and shook his head and realized that what I was saying made sense. And we went on with our meeting, but then he asked the question again before he left. So, so it's something that people are thinking of, for sure. But the answer is almost always not to chase returns, but to chase your dreams.
Right. And
try to get that one financial life that you've always wanted, to try to make that happen.
Yeah. Yeah. I think that's really important to keep in mind. And you have to consider if this is something you're struggling with and you're saying, I don't want to have bonds creating what appears to be a drag on my portfolio returns. You have to ask yourself, would you want them in a year that the S&P 500 lost 30% or 40% and you're right in the middle of retirement or about to begin retirement? Would you want to be fully exposed to that? For most people, if you're in the heat of that moment, for most people,
the answer would be no.
Yeah, exactly. You want to have a cushion there, because that's when you realize, now I've got to sell my shares, and I I had $1 million and now I have 700,000. And you've got to take those losses. And
Right.
you know, in that moment that is going to put a dent in your portfolio.
Archie, before we run out of time, I wouldn't be being me if I didn't give some sort of unimportant trivia to the episode. So when I was a kid and I would hear the term coupon clipper, I always thought that a coupon clipper was someone who would get the Washington Post in our area and pull out the section with the coupons, clip them, and then take those to the grocery store or the drugstore and save money on their shopping. In reality, it goes back to a reference about bonds. So when bonds were issued, oftentimes they were a paper certificate with little tags at the bottom called coupons, and you would clip that and take that to your broker or maybe to your bank and turn it in for an interest payment. So that's where the idea of coupon clippers come from. I noticed that you referred to the interest rate that's paid on a bond as its coupon. It goes back to that bit of market history.
Yeah, that's really neat. And I didn't know that before we had discussed that. And I think that's a neat little piece of history.
Yes.
And
Sometimes age is beneficial, right? So anyway,
you can actually go on, I was looking on eBay, you can go on eBay and other places and get old bond and stock certificates, the paper ones, because they're
really
such an
cool.
interesting piece of history. They're really ornate and cool. But anyway, so that's all for today. We hope this was useful to you. Remember to like, subscribe, and leave a comment with a question. Right? We'll use that for an episode, or we'll reach out to you directly. And we hope this has been a good episode for you, and we hope you tune in for the next one. So thanks a lot. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.